Hello everyone, this is Professor Zhao at MTSU. I think we just went through the most difficult part of this course, the portfolio theory, and as I said, this course combines both theory and the practice of portfolio management. And right now, we are going to go through a pretty easy module, and in the second module, we will look into what a typical daily life look like for a money manager. The content will be covered in chapter 22. And also we will have a brief survey on both mutual fund industry and hedge fund industry. Right. Now let's begin our discuss for chapter 22, investors and investment process. So let's say you are a professional money manager and your job is to help your clients to manage their assets. And in the United States, a lot of money for those money managers to manage, and it's not in millions but in trillions. And the most money is in form of retirement plans. And I mean, if you are employee of a company, you know that each every month, both you and your employer needed to deposit certain amount of money to your retirement plan, such as a 401k. So once you put the money in those retirement plan, who's going to manage it? It's not you. And your company will allow you to choose different asset management companies, or the financial companies to manage your wealth. So in this chapter, we will look at what a money manager's life look like on a daily basis, and how do they conduct their money managing business. You might imagine that so-called portfolio managers or money managers they constantly trading securities on the daily basis. And after we finish this chapter, you will know that is not truth. And it's very likely that a typical money manager will spend less than 1% of their working hours in actually trading securities. Right? So your question is, what do they do during the 99% of the time? Well, during that 99% of the time, they needed to, first of all, build a friendly relationship and trustworthy relationship with their clients. Remember, here the role that money managers are playing is to help others to manage their money. And the client always is the first that a money manager needs to attend to when they conduct money managing business. Now, let's take a look at what a typical money manager needed to do on a daily basis. And actually, there are three different types of activities that they need to go through. First one is planning. So before you guys want to trade the securities as a money manager, you needed to do a lot of homework. You needed to plan your business pretty well in order to be successful in the future. And the second stage is the execution. Even on the execution stage, money managers do not spend a lot of time trading, and actually they spend a lot of time do research, do homework, and also they need to revise their research on the quarterly basis, maybe on a monthly basis. It's a continuous research process, helping them to make the right decision for their clients. And in this stage, of course, they trade securities based on their very serious investment decisions. And after they, let's say they trade, they develop a mutual beneficial relationship with their clients, and then they do a lot of research, made decisions on asset allocation, based on their market research and develop the investment strategies and actually trade the securities, you would say, okay, the job is done, right? But at this point, I would say that once they establish a well-diversified portfolio for their clients, this is just the beginning point of their portfolio management process, because it involves continuous monitoring process. And over time, what we know about this financial market is it's ever-changing place. Everything will change in the future. So in the future, when market environment changes, when your clients are changing, money manager have to revise their research, revise their plan, revise their practice, and it's a continuous improvement work that they need to do. They need to monitor the market, monitor the portfolio, monitor the ever-changing market-wide variables, as well as changing status of their investors, so that they can serve their clients better in the future. So so we have third stage of this management process, which is the feedback. Right. And as you see, there are many different activities involved in portfolio management. And on the planning stage, what do we need to do as money manager? First one is specification and qualification of investor objectives, constraints, and preferences. And on this stage, what you needed to do is to know your clients, right? And you wanted to communicate comprehensively with your clients to see what do they need from your money managing business. And you need to understand their goals, their objectives, their constraints, and their preferences in terms of return and risk. And that is a critical part for you to develop your portfolio policies and strategies, because you are not serving yourself but serving your clients. And in order to establish a well-rounded portfolio policies and strategies, money manager need to do a lot of research. They needed to do a lot of forecast in terms of future capital market performance, individual companies' performance as well, and this is so-called capital market expectation. And the capital market expectation start with your top-down analysis. On the top, you look at economic environment, social environment, political environment, right? And here you want to develop your forecast in terms of where this market is heading. Not just for the next couple of years, but for the next 20, 30 years. And that is called a capital market expectation. That is a tremendous amount of work that you have to devote to as a money manager in order to develop a well-rounded portfolio strategies for your clients. And on the execution stage, what you needed to do first of all is to make the decision on asset allocation, on how to optimize the structure of your portfolio. Then you do security selection. Once you select investment for different sectors, for different classes and individual security, then you do implementation, or also called execution. And here implementation means you actually trade those securities. This is just a small part of work that you have to do as money manager. As you see, you spend a lot more time in communicating with your clients, and you spend a lot of time to do capital market expectation or doing market forecast, and you spend a lot of time to formulate the investment strategies and your portfolio policies. And once you construct a well-diversified portfolio, as I said, it's not the end of your work. It's beginning. It's the beginning of your daily work as money manager. You need to monitor the economic and market situations on a daily basis, because everything will be changed in the future, and you wanted to incorporate ever-changing environment into your portfolio management process. And There's certain feedback process that you need to take care of, and you look at those environmental changes, clients changes, and those changes are input that you need to collect as you go through the feedback process, and as a response to those changes, of course, you want to change your asset allocation decision, your portfolio optimization, as well as your individual security selection. So this showed you a big picture on what an asset manager or money manager needed to do on the daily basis. Remember, it's not trading securities, right? It's not about trading securities. Trading securities is just the one small part of their job. They need to spend a lot of time do communication, do research, and decision making as well. Of course, there's a continuous monitoring and a continuous improvement work that they need to do. Now let's take a look at the details of investment management process. And from the previous picture, okay, there are three different types of activities that money manager need to be involved in. First one is planning, and on the planning stage, there are 4 different jobs for there to do. First one is identifying, specify the investor's objectives and constraints. And the second job is to create investment policy statement. The third one is forming capital market expectation, and the last one is to create the strategic asset allocation. Right. So let's start with A. A in this planning stage, identifying and specifying investors' objectives and constraints. So on this stage, what a money manager needed to do is to have a comprehensive conversation with their clients, because you are managing your clients' money, you're serving your clients' needs, and you needed to know what do they need. An investor, of course, will express their goals for their wealth management, and those goals are also called objectives. And also you need to have a deeper conversation with your clients in order to understand what are constraints they have, right? Do they have liquidity needs? Let's say they needed to withdraw money 5 years from now to deal with certain expenditure, such as kids' college education, retirement, so on and so forth. So on this stage, you need to understand what your clients needs. And B is to create investment policy statement. Investment policy statement. That is a very, very important documentation for your money managing business. Essentially speaking, this investment policy statement, or IPS, is a formal contract between you, money manager, and your clients. So all the rights and obligations is going to be written into this very, very important documentation. And a typical investment policy statement can be as long as 100 pages or even more than 100 pages. And there are different forms that you can find for a typical investment policy statement, but no matter how different the forms are, a typical investment policy statement will contain the following content. First one is investors' objectives and constraints. And the second one is money managers' capital market expectations. And the last one is strategic asset allocation policies. So here, this document will show very clearly what is goal of your clients, right? And what is the risk-return trade-off they are expecting. And the second, you want your clients to know how do you achieve what you will be doing to achieve your client's goal by laying out very important portfolio management policies, and especially on the asset allocation level. So that is a planning stage. On the execution stage, of course, you wanted to do a little bit more detailed work on asset allocation. And Previously, you established strategic asset allocation policy, but in this section, you wanted to develop tactical asset allocation to deal with the daily volatility on the market. Right? And strategic asset allocation involves the portfolio policy that money manager need to follow for the next 10, 20, or even 50, 100 years. Right? That's why it's called a strategic asset allocation policy. It's a long-term policy. But in the short term, market changes very frequently, and money manager need to formulate so-called tactical asset allocation as a response to the ever-changing market environment. And on the execution stage, money manager also need to do a lot of quantitative work to make sure that a portfolio that they invest for the investor actually can achieve optimal level of risk-return trade-offs. Right? So that is a portfolio optimization work that a money manager need to deal with. B, security selection. Once you made the decision on the asset allocation, it's time for you to select individual security, individual stocks across different industries, sectors. Maybe you want to add some bonds, treasury securities to manage the risk-return trade-off. At a certain time, you want to invest in alternative areas such as real estate, commodities, so on and so forth. And once you made the decision, you would say, hey, exciting thing hasn't happened yet. You really want to make security trading happen, but here is the stage where you actually do trading, implementation and execution, right? And you need to trade securities to implement your asset allocation decision as well as individual security selection decision. And the last stage is feedback. And on this stage, of course, you need to do monitoring. You want to monitor the market condition very closely, right, for the portfolio. And other than that, you also need to look at other changing variables, such as the situation that investors are facing, right, and the economic environment, as well as stock market input factors. And the monitoring the monitoring process require money manager to do rebalancing as the response to ever-changing environment, ever-changing financial market environment, and those changing variables as well. And the last stage is performance evaluation. Here's the exciting yet very hard part that money manager need to go through every quarter. Right? You do a lot of work, do a lot of research, and trying to deliver the best results for your clients. But at the end of every quarter, you needed to show your clients the result. Are you making money for your clients? Are your clients will be happy with the risk-return trade-off of the portfolio that you're holding for them? So on this stage, you wanted to do a little performance evaluation, right, to show your clients that your business is on the right track. So every quarter, there's a final exam for those money managers, right? If clients are not happy with their performance, they're gonna be they're gonna withdraw money from the fund and go to other places. And money managers are constantly under pressure of performance evaluation, not just on an annual basis, but on a quarterly basis. Right? And we'll learn a lot of detailed techniques in terms of how to do performance evaluation based on risk-return trade-offs. Now let's take a look at investment policy statement. So investment policy statement is extremely important documentation for any money manager, because this documentation represents a contract between money manager and their clients. Right? And this statement should include the following 9 basic items. First one is description of your clients. Right? The second one is purpose of establishing policies and the guidelines. The third one is to specify duties and responsibilities of money manager as well as other parties involved in this contract. And the fourth one is the statement of investment goals, objectives, and constraints. Right? And those elements are directly can be directly obtained from the conversation between you and your clients, and you need to know what do they need, what do they need from you guys in terms of investments. And the fifth one is to schedule a review of investment performance and IPS. So this review process is a necessary step that the money manager has to go through for the dynamic monitoring process. The sixth one is performance measures and benchmark. As I said, when professionals doing performance evaluation, there's certain benchmark they need to define, and also the performance measures need to be carefully defined so that you and your clients are on the same boat in terms of how to interpret the results of your investments. And the seventh is any consideration in developing strategic asset allocation. So here you put a lot of focus in a very important decision called asset allocation. And the eighth one is investment strategies and investment styles. So you made the decision between active stock picking versus passive investment strategies. And the last one is guidelines for rebalancing. Right? So when you do this portfolio management project in this class, as I said, you needed to do it differently from the one that you did in your investment class. And in this class, when you play this $10 million portfolio management game, you are going to play a role of money manager who's managing tens of millions $, not for you, but for your clients. Right? And before you jump into account to make, let's say, 10, 20 transactions, I want you to pause a little bit, right? Because from here, you know, as money manager, first thing that you needed to do is not to trade, but to establish a well-defined investment policy statement. That would be the first part of your project writing. So I want you to think about who your clients are and what is their objectives, what is their constraints, and what would be the duties, responsibilities for you to serve your clients, and I want you to follow this list to establish your own investment policy statement. It doesn't have to be 100 pages long, not even 20 pages long. I want you to develop a very concise investment policy statement for your portfolio game. Ideally, about 1 page or a little over half page, but no matter how short it is, you should incorporate the following 9 major items in this investment policy statement, as you see here. Okay, in this investment policy statement, first thing that you need to specify is your investors' objectives and constraints. So what is objectives? Objectives only deal with 2 very basic things. First one is return. The second one is risk. Right? And you should always communicate with your investor and clients that the most important thing for their wealth management is not all about returns. Of course, when your clients approach you, they of course will express their expectation for the return. They might say, "Hey, I want you to make 10% each every year, ideally 20, 30, or 50, 100%. Of course, any investor prefer higher return. But as a professional, you need to educate your clients that, okay, higher return goes with higher risk. Higher risk means potential that your clients may lose large amount of money during a certain time period. Right? So you need to highlight the importance of risk to your clients, right? And let your clients know that what they can get from this money managing business is a very sound risk return trade-off. Not just returns, but a combination of return and risk. So in this IPS, in the contract between you and the clients, you and your clients going to reach the consensus in terms of that risk return trade-off. So the first thing that you want your clients to tell you is how much risk they can bear. Right? How much risk they can bear. Then the return would be easily derived from CAPM. I mean, if your clients is willing to bear, let's say 1.2 beta, measured by beta, as the risk, then okay, you can tell them that the expected return for this amount of risk would be, let's say, 12%, 13% on an annual basis. Right? And your clients wanted to bear a lower amount of risk, then you can tell, okay, at this certain level of risk, then your expected return would be 8-9%. Right? If your clients want to say, hey, I want you guys to deliver me 30% of return, and you would say that is possible, but the tremendous amount of risk involved in the portfolio that you hold for your clients, and beta could be 2-3, right? And it's very risky choice that you and your clients are going to make together. So this objectives is all about risk return trade-off from your clients. And any clients have constraints, and the constraints can be demonstrated in 5 different aspects. First one is liquidity needs. Right? Liquidity needs deal with situation where your clients need to withdraw a large amount of money from their accounts for certain expenditures, and very typical expenditure would be okay, sorry about the interruption. Let's continue our class. We are talking about investment objectives, and investors' objectives can be very different depending on who your clients are. Let's take a look at a typical investment objectives from an individual investor. Right? And from an individual investor's perspective, they often ask you to deliver a high return, but you want your clients to know that okay, the return is a natural consequence of risk bearing, and the different individual clients may have different preferences for risk taking. Such, for example, young investors tend to express that they're willing to bear more risk for higher returns, and for older investors, they tend to be more conservative, and they probably will tell you that okay, they don't want to take a lot of risk. But on this stage, you want your clients to know that okay, the willingness of taking risk is different from the capacity of bearing risk. For typical young investors, they have a new family to take care of, and there are a lot of scenarios they needed to meet their daily cash expenditure needs. And in this case, although they have willingness to take higher risk, but you should let them know that okay, you guys have kids to take care of, right? Your job is not 100% secure, and at a certain time, you really wanted to know that you don't have high capacity to bear risk. And for older investors, they tend to be overly conservative, but you should let them know that okay, you don't have kids to take care of. Your kids are graduated from college, and you don't have a lot of cash expenditure to deal with. And also the excuse me, the wealth level that older investors have allow them to take higher risk to earn higher returns. So although they may express that they are not willing to take a lot of risk, but you need to let them know that they have higher capacity to take risk. So when you consider both willingness to take risk and the capacity to take risk, you will have a comprehensive evaluation on their total level of risk tolerance. Right? It is risk tolerance level that actually determines the expected rate of return for individual investors. And it's very common that as a money manager, you are not likely to deal with individual investors. It's more likely that you need to deal with those institutional investors. And those institutional investors could be a bank, could be an insurance company, or a corporation that offers you a lot of retirement plans to manage, or even a government agencies. Right? And those institutional investors often ask you to manage not just thousands, 10,000 US dollars for them, but millions, tens of millions, or 100 millions US dollars for you to take care of. And we have different types of professional investors or institutional investors for you to deal with in the future as a money manager, and you need to keep in mind that those institutions are doing very different business, and the nature of their business actually defines different objectives for their investments, and also different institutions are facing very different constraints. Right, so we have several slides showing you, okay, different investors, especially those institutional investors, do have different nature of business that require you to design different investors' objectives and constraints for them. And here is the table showed you very different risk-return trade-off that a typical investor may require for your business, right? And for individual investors, their risk-return trade-off requirement involves the life cycle of that individual, right? And for mutual funds, it's very different because different mutual funds have different prospectus, and you have to look into the prospectus to see how they do their business, right? And of course they have different requirements for return and risk. And for pension funds, endowment funds, life insurance companies, non-life insurance companies, as well as banks, you see, from this table you see their risk tolerance level are very different, and return requirements are also very different. Now let's put a little bit more focus on investors' constraints. Investor constraints actually put limits on what you can do for your clients. And there are several different constraints that you need to consider. The first one is liquidity. And liquidity is speed and easy with which assets can be converted into cash. And in the context of asset management for your clients, it is the need. It is the need for cash from the asset that they need you to manage. Right? For example, life insurance company have long-term claims from their clients, and although every month they might add more money into their account due to the revenue from the life insurance premium, but periodically they needed to withdraw a large amount of money from their account to deal with the claims from their clients. So that is liquidity needs that you need to consider for different types of your clients. And the second one is the investment horizon. Some institutions may ask you to manage their assets on a short-term basis. Others may ask you to manage their assets in the longer-term basis. And investment horizon actually affect the risk-return trade-off of your clients. And typically, if investment horizon is long, with not much liquidation needs, then you can allow your clients to take more risk, and higher risk will eventually lead to higher returns. But for investors that have shorter term investment horizon, that you have to be very conservative in terms of the risk that they can bear, and of course a lower return would be expected. The third constraint that you need to consider is the regulation. The regulation that your clients are facing. For example, if your client is a mutual fund, then okay, there's a regulation concerns for any mutual fund. They may not hold more than 5% of stock of any publicly traded corporation. Mutual funds have very strict policy for diversification. So in that case, in your portfolio, you need to identify that okay, any individual security should not exceed 5% of the total investment value. And for both mutual funds and hedge funds and other asset management companies, there's a certain principle they need to follow, and one of the most important one is called a prudent investor rule or prudent man principle. And this principle defines a fiduciary responsibility of professional investor, and this responsibility actually require money manager to be a little bit more conservative than your investors require. So let's say your investor think they can bear a medium level of risk to generate a medium level of return. And in this case, as a money manager, you want to follow this prudent man principle. Right? And when you construct a portfolio for your clients, you want to make sure the risk in this portfolio is a little bit lower than the median level. So that is a prudent investment rule that any money manager need to follow. And the fourth type of consideration is tax. And often you will show your clients the nominal rate of return, but your clients may have different taxation situation. Right? For example, if it's endorsement fund, right? If it's a non-profit endorsement fund, the tax may not be a concern because those institutions have tax-exempt status. But for for-profit corporations, no matter it's mutual fund, hedge fund, banks, insurance companies, you needed to let your clients know that okay, this is a nominal rate of return for your portfolio, but since your institution is subject to both local and federal taxes, then you need to calculate after tax returns for your clients to let your clients know what is the after tax return that they can get. And the last one is the unique needs, and the unique needs deal with the unique situation of your different clients. For example, let's say one of our clients have higher ethical standard for their business practice. Although you can invest any type of stock for them, but they want you to stay away from tobacco industry, right? Tobacco industry, because their institution is very sensitive to human health, and they don't want to make money through those health the industry that undermines human beings' health. That is unique needs. Right. So here you see a big table showed you very different constraints from different investors. Right. For example, for life insurance companies, they have low liquidity needs, but for non-life insurance companies, they have high liquidity needs. And for a bank, their liquidity needs low. And in terms of time horizon, pension fund, endowment fund, and a life insurance company tend to have a long investment horizon, but for non-life insurance company banks, they tend to have a shorter horizon. And for regulations, for pension fund, they needed to follow a very restrict industry regulation law called ERISA. Right? So from money manager's perspective, you wanted to do a little research in terms of what the law is, what the regulations are, and so you can follow the regulation, make sure your business with your clients is legitimate. Okay, once you communicate very well with your clients to reach the consensus in terms of risk return objectives, then it's time for you to make a very, very important decision called asset allocation. And essentially speaking, money manager needed to make two different types of investment decisions. And the first one is asset allocation. And the second one is individual security selection. Right? So first one, they need to make a decision on how much money they want to allocate in certain asset classes. Asset classes could be bond versus stock. Right? It could be larger stocks versus small stocks. Those are different asset classes. And the asset allocation decision have a huge impact on the performance of a well-diversified portfolio. Right? And based on research, more than 65% of performance in a typical portfolio is determined by asset allocation decision. Right? And here you see two different types of asset classes. First one is money market assets, and in this category, the risk return is very unique. First of all, it's very liquid assets. And you can hold money market assets for clients that have a higher liquidity needs, right? And but money market assets only offer very low return, because the lower risk and the high liquidity. And in another category, that is a fixed income securities. Mainly, those are bonds issued by U.S. corporations or U.S. federal governments, right? And introducing fixed income security into your portfolio, of course, will improve the benefits of diversification and lower the risk. But most of fixed income securities offer lower return than stocks, right? So the rationality of buying bonds is not to improve return, but improve diversification and manage risk. Of course, most mutual funds and other money managers will invest large amount of their clients' assets into the stock markets. And on the stock markets, there are different asset classes that you should consider. You can look at value companies versus growth companies. You can look at large companies versus smaller companies. And also you can divide your stocks into different sectors. Also, you look at the income streams from a certain stock. You look at dividend-oriented stocks versus capital gain-oriented stocks. So typically you need to make a decision between bonds and stocks. And in the stocks, you need to make a decision between different sectors, between different types of stocks. But here, it's not that the decision is associated with individual securities. You see, it's not individual securities. It's the allocation of your money into different asset classes. Other than bond stocks, you may consider alternative investments such as foreign stocks or foreign bonds, real estates, not in physical form but in financial form such as REITs, as well as commodity investments. So how do we make decision on asset allocation, right? I mean, you can say, okay, I want to put 20% in treasury bonds, 80% in stocks, and among stocks, you want to allocate 30% in foreign stocks, 70% in domestic stocks, and among domestic stocks, you want to divide your assets between, let's say, 5 different sectors: healthcare, consumer staples, financials, information technology, so on and so forth, right? But before you think of a arbitrary number, you wanted to know what are factors that you need to consider. to make this asset allocation decision. Right? Essentially speaking, there are two factors. First one is your clients' objectives. Right? What does your clients need from you, right? In terms of risk-return trade-off. And the second factor is the capital market expectation. That is your analysis in terms of future risk and return of those different asset classes. Right? And asset allocation decision will be based on your capital market expectation and your client's objectives, as well as constraints. And here is a very typical structure for a money managing company. And on the top, you will see investment committee. Right? And in the investment committee, you have some senior executives of the company. And what they do as investment committee is not to pick individual securities. Right? Instead, they make upper level decisions in terms of investment policies. And they will look into or verify the process of implementation of the investment policies. So they are doing macro management of the company. And the investment committee also make decision in terms of what they can invest it in, right, based on the principle of asset allocation. So the investment committee need to establish the assets universe that a company can involve in. And the last one is to formulate broad asset allocation decision, which means this decision is strategic decision. It's for the long term. And then later on, the money manager need to make a decision on tactical asset allocation as a response to the volatile market situation. But the investment committee, as the executives of the investment company, need to formulate a long-term asset allocation policy for the company. This picture showed you a very typical example of asset allocation. Right? Asset allocation is all about allocating your money into different asset classes. And here we can distinguish different assets in terms of geographic areas. And here we have 75% invested in U.S. domestic market and 25% in Japan, a foreign market. And within the U.S. category, the company may invest money into 3 different asset classes. And those are cash, 15%, 40% of fixed income securities, and 45% in stocks. And in the foreign part, in the Japan category, company may invest 60% in fixed income security and 40% in stocks. So that is the asset allocation decision that money manager needed to make. And under the dashed line, you see the process of security selection. Right? Let's say this company is going to invest 15% of assets in their U.S. sector. Then, okay, how to invest that amount of cash? And here, company can choose T-bills. Right? I mean, cash doesn't have to be cash because cash generates 0 return. As alternative, a company can invest in money market instruments as alternative form of cash, right? And it has same nature of cash because it has high liquidity. You can convert back to cash in just a couple of seconds by selling treasury bills. But the treasury bills, once you hold it, it can generate certain amount of return. Right. So here you can say, okay, I wanted to invest the amount of cash in one security, treasury bills, right, that has 11.25% of coupon rate. And in the fixed income category within the U.S., you might want to allocate 60% in treasury bonds and 40% in bonds issued by AT&T. And for your stock portfolio, for your U.S. stock portfolio, you can make a decision like, okay, I want to put 45% of money in IBM, 35% money in GE, and 20% in ExxonMobil, so on and so forth. So under the dashed line, you see money managers are making security selection decision. So asset allocation versus security selection, those are two major decisions that money managers need to make for their clients. Now, after the decision for asset allocation, what do managers need to do? Well, they need to establish investment policies to determine what kind of investment style they want to follow. And here, there are two very different types of investment strategies or policies. The first one is active portfolio management. The other one is passive portfolio management, right? So what's the difference? The difference is that active investment policies require managers to pick individual securities, right? But for passive portfolio management, manager only needed to follow the market index. And the fundamental difference between active and a passive portfolio management is that under the active investment policies, the managers tend to believe they are smarter than the market. So they want to make individual security selection decisions, and so they can beat the market index or market average. And their goal is to outperform the market by selecting outperforming securities. Right? And here they believe they are smarter than the market. They don't believe the market is 100% efficient. But if manager is believing the market efficiency story, if they believe that they cannot beat the market because the market is efficient, so the natural solution here is not to pick individual securities, but to follow the market by investing market index fund, or simply mimic the structure of market indexes. And we call this as a passive investment policies. Right? And for a typical money manager, you would say they either follow active or passive investment style, but most managers actually do both. Right? They might allocate certain percentage of money into their actively managed portfolio and the rest into the passive managed portfolio. That is pretty common. So once money manager made decision on asset allocation and security selection, build a portfolio for their clients, as I said, it's not the end of their job. Their job is to monitor and revising the investment practice for their clients on a continuous basis. Right? So by the time of implementation investment strategies, all the securities are in place in their portfolio. At that time, you know that time has passed. Right? And what you need to deal with is the ever-changing environment for next month, for next quarter, for next year, and for next 10, 20 years. And as time moves on, you will see a lot of things will change. A lot of variables will change, and even your investor status will change. So it's necessary to revise your strategies on a timely basis. Right? Your client circumstance may change, and the market environment will change. It requires you to do the balancing. You change the portfolio weight as a response to your client's needs change. Your asset allocation may change due to the market conditions, and investing as a dynamic process must be updated and re-evaluated on a periodic basis. So your question would be that how often that money manager needed to revise their investment policies to rebalance their portfolios. And typically speaking, every quarter, money manager need to do a significant revise on their investment strategies, revise on their capital market expectation. And on an annual basis, they need to communicate with their clients to see if any situation has been changed from their clients' end, so they can make the corresponding changes for their portfolio. So remember, portfolio management is not about, okay, you do homework today and you made a decision and that's it. It's ever-changing dynamic process, continuous monitoring, continuous improvement for your clients. Right? So that is the major content that we need to cover for chapter 22, investor and investment process. Now let's spend a little time look at the homeworks that you may come across for your homework and future exams. Chapter 22, investment policy. In this pretty straightforward chapter, and basically there's no calculation involved. I would say it's pretty easy for you to deal with. Now let's take a look at those questions. First one. The first step an investor should take before beginning to invest is to do what? As we know, to communicate with your clients to see what do they need. So A is correct. Establish investment objectives with your clients. Number 2, which of the following is the least likely to be included in the portfolio management process? 3 stages: planning, execution, feedback, with different text to deal with. And here you see A, monitoring market condition, relative values; B, monitoring investor circumstances; C, identifying investor constraints, preferences. Those are all important steps in portfolio management process. And D, organizing the investment management process itself is not one of them. So D is the correct answer. Number 3, the 2 most important factors in describing an individual's organization investment objectives are C, return and risk. And here is required rate of return based on risk tolerance level. So the best answer is D. Number 4, personal trusts are typically allowed to engage in which of the following investment activities? Buying, selling futures contracts, pretty risky action. Short sell, purchasing, writing options, buying stocks on margins. And you can look at a typical investment policy statement for personal trust, and you will see that none of those are allowed. So the best answer is D. Number 5, the risk that a downturn in the market may substantially reduce your investment principal is called market risk, because the risk here is caused by the market movement. Number 6, empirical evidence confirms that investors become more or less risk tolerant or averse as they approach retirement. And the observation will tell you that, okay, when investors are getting older, they tend to be more conservative. They become more risk averse. They want to stay away from the risk. So the answer is C. Number 7, of the following, the investment time horizon typically the shortest for which one of the institutional investors that you see here? Banks, endowment fund, insurance companies, pension fund. And we know that the BCD all have long time horizon, and only bank have short term horizon for their investment. So answer is A for number 7. Number 8, a passive asset allocation strategy involves what? A, investing in stock or company that are price takers. B, maintaining approximately the same proportion portfolio in each asset class over time. C, varying the proportion of portfolio in each asset class in response to changing market conditions. And D, selecting individual securities in different sectors that are believed to be undervalued. Right? So definitely not D, because you are a passive investor, and between A and B, I would say B is the best answer. Number 9, an active asset allocation strategies involve what? invest in stock company that are price taker, maintain our. It's the same chart that you see number 8, and C, varying the proportion portfolio in each asset class in response to changing market condition. And I would say C is the best answer. Number 10, the amount of risk an individual should take depends on his or her what? First, risk return requirement, risk tolerance, and a time horizon. And actually, it has something to do with all of them. Right? Return requirement, risk tolerance, time horizon. They all affect the amount of risk that an individual can take. So the answer is D. Number 11, the prudent investor rule requires professionals to do what? And the best answer is D. Professionals who manage money for others to constrain their investments to those that would be approved by a prudent investor. They need to take a little bit lower risk than what their clients could. Number 12. The prudent investment rule is an example of regulation designed to issue appropriate fiduciary responsibility by money manager. It's fiduciary responsibility. Number 13. An investor has a long time horizon, desire to earn the market rate of return. However, investor will need to withdraw funds each year from her investment portfolio, and the biggest constraint planner would face with this client is a liquidity constraint. Liquidity constraint deal with needs of cash withdrawal from your clients. Number 14. The choice of an active portfolio management strategy rather than passive strategy assume that A, the ability to continuously adjust the portfolio to provide a superior return. Sounds good. B, asset allocation involve only domestic securities. C, stable economic condition over the short term. D, the ability to minimize trading costs. I think the best choice is A. Right? And adjust the portfolio to beat the market, right, by providing a superior return. That is the goal for active portfolio management. So A is the best answer. Number 15, a little bit numbers here that you see. Both the wife and her husband work in the airline industry. They're in their 40s, right? And they have a high tax bracket, and they're concerned about the after-tax rate of return. A meeting with a financial planner revealed that they are primarily focused on long-term capital gains and will need at least 9 to 11% annual average rate of return to meet their retirement goals. They desire a diversified portfolio, and liquidity is not currently a major concern. Right? So here you have 4 potential solutions of asset allocation for this couple. Right? A, 10% money market, 40% long-term bonds, 10% commodity, and 40% high dividend paying stocks. B, 0% in money market, 60% long-term bond, 40% stocks. C, 10% money market, 30% long-term bond, 10% commodity, 50% high dividend paying stocks. And D, 5% money market, 30% long-term bond, 5% commodity, 60% stocks. Most with low dividends but high growth prospects. So here you see a difference in, first of all, the money market allocation, right, from 0% to 10%. And in this case, which one would be the best? I would say 5% makes sense because this couple has a low liquidity needs, but not as low as 0%. And the other objective that a couple express is the return, something between 9 to 11% return. 9 to 11% return. And at this level, you probably want to allocate a lot of money in stock in order to achieve higher return. I mean, it looks like B is not a good choice because you put 60% in long-term bond, which may not be able to achieve total return 9 to 11%. Right? You want to make sure majority of investments is on the stock market. Right? So comparing 4 choices, you would say, hey, D would be the best. Right? 5% money market allocation is suitable for clients' liquidity needs, right? 60% in stocks with high growth prospects that can help to achieve 9 to 11% average rate of return. And you also have 30% allocation in long-term bonds and 5% commodities. I would say this is a pretty balanced portfolio for this couple. So this is the best answer. Number 16, a family will retire in a few years. They have high tax brackets and are concerned about the after-tax rate of return. Meeting with a financial planner revealed that they have primarily focused on safety of principal and will need 6 to 8% average rate of return. They desire a diversified portfolio, and liquidity is likely to be a concern due to health reasons. So it asks you which one is the best choice. Of course, there's no perfect choice. You simply pick the best one here, A, B, C, D. Right? You look at a cash position. Cash position range from 0 to 10%, and in this case, this family has high liquidity needs. Therefore, you pick 10% money market allocation. Right? And another concern is the return and the risk as well. And they prefer lower return and lower risk. Right? So let's compare the return and risk for those four choices. A, 50% intermediate term bonds, 40% blue chip stocks, many with high dividend yields. It looks like this is a pretty safe portfolio, which will generate typically something around 6 to 8% of total return. B, 60% intermediate term bond and 40% stocks. So compare A and B. Which one's better? I mean, it doesn't specify types of stocks. Could be very risky stocks. So I think A beats B because it is specified that okay, those are blue chip stocks. Those are low risk stocks with high dividend yields. So A is better than B. What about C? C, 30% intermediate term bonds and 60% high dividend paying bonds. So let's compare A and C. They are same cash position, but A has lower allocation to stocks, right? C has a higher allocation to stocks. And in this case, I would go for A because A is safer choice because A has more allocation in bonds, which is safer than stocks. So I would say A is the best answer. Number 17. Major functions of investment committee include all but which of the following. Right? And the investment committee they do not involve in the detailed investment decision process, right? And they do not pick individual securities, but they do establish the major principle for asset allocation, duties, responsibilities, so on and so forth. Right? So the answer is A. They do not engage in security selection for each portfolio manager, but they do asset allocation. They determine asset class weights for each portfolio, and also they determine the asset universe, as well as performance measures, so on and so forth. So A is the best answer. Number 18. A portfolio consists of 3 index funds, an equity index accounting for 40% of the total portfolio, bond index for 30%, and international index for 30%. After each quarter, the portfolio manager buys, sells on each sectors to preserve the original weights for each sector. This is example of what? It is active managed fund. Well, this is a typical passively managed fund, and the asset allocation decision has been made: 40% for equity, 30% for bonds, and 30% for international. And over time, those weights will change due to stock price changes. But a passively managed portfolio requires the manager to rebalance the portfolio, right? To maintain the initial asset allocation structure. So this is a totally passively managed fund. So B is the best answer for number 18. So chapter 22 is a pretty straightforward chapter, and you might want to read the textbook a little bit, and let's do more discussion in the later chapters in other videos.